Everybody, this is Bub, making a few observations about the January 12 USDA report, one of the top three reports of the year. The first point is in the option market. Going into the report, corn and soybean option volatility and prices were low. Coming out of the report, those implied volatilities and prices are even lower. It's not an infallible prediction, but for us, implied volatility by definition is the market's collective assessment as to how volatile the futures will be in the near future, going out to maybe 4, 6, as much as 8 weeks. So the market outlook going into the report and coming out of the report was for muted volatility in corn and soybeans, and that is exactly what we think is going to happen. The second thing is the reaction to the report was soybeans were up sharply and corn was barely unchanged. In effect, that pushed the corn-bean ratio, the November beans and December corn ratio, back up toward the 2.7 highs that we saw a few weeks ago. In a way, this is a self-defeating move because it creates an enormous incentive for planting soybeans at the expense of corn, and it also the report showed that hard red winter wheat seedings were at a 109-year low, and that also creates an incentive to plant at least some of those acres to corn. So on the margin, to soybeans. So on the margin, soybeans plantings we think will be quite a bit higher given the current state of affairs. Normal, I should say, is a 2.3 ratio. That's where it's been the last 5 years. 2.4 1 year, but 2.3 the others. That is quite far away. To put it in perspective, soybeans would have to stay at their current price with corn rallying 55 cents, or soybeans would have to break 130 cents with corn not moving at all. More realistically, soybeans could drop 65 cents and corn up 25 cents. That is a little bit more realistic as a scenario, but still, that is quite a lot to ask, that corn rally and beans break at the same time. In conclusion, therefore, we think a lot of soybeans will be planted, probably more than the market is making an assessment about. The South American soybean crop in Brazil is doing excellent. There's some problems at the margin in Argentina, but in some ways that's a drop in the bucket compared to what's happening to the crop in Brazil, which is well on its way to being a very good crop. The trade wants to believe that no matter what the supply of soybeans is, no matter how large it is, and no matter how high the price is, the world demand will be there to take it all on. I'm going to leave it to you to decide whether that's a realistic assessment or not. Thank you. This is Bub. See you later.